Good day, everyone. I'm the City Florence Alvar, and today we're going to discuss about our last topic for entrepreneurship, which we are covering Module 10, which our topic is all about bookkeeping. In our lesson 1, we are going to discuss or cover the perform bookkeeping task. So, what is bookkeeping? Bookkeeping is a process of recording business transactions. It is called systematic, meaning to say it follows procedures and principles. It is also called chronological, meaning it in order of the date of occurrence. Like for example, if we start on April 4, so our transactions will also start in April 4 and it will go on and so on. Next is the one who is in charge of recording, which is the bookkeeper. He is also the one who is maintaining or who maintains and update business records from all sorts of financial transactions using account title that can be found in the charts of accounts already set up and accounted. The bookkeeper is also the one who uses the book of accounts, which is to record the business transactions, which is to consolidate later to help construct financial statement such as trial balance, income statement, and balance sheet. In the book of account, there are two types of books used in recording business transactions. They are called journals and ledgers. Journal refers to the book of original entry, while the ledger refers to the book of final entry. Meanly to say, the book of accounts contains a general journal and a general ledger. So what is in general journal? In a general journal, it is the most basic journal which provides columns for the date, account titles and explanations, folio or reference, and a separate column for debit and credit. So the general journal looks something like in the presentation, although it is still blank. However, if we consider the format, we have the date, we have the account, we have the debits and credits, and we are going to record the transactions within the journal. That is why we put the date, we're gonna put the debit, so we're gonna put the debit in the debit column, credits in the credit column. We could have also put the indentation on the credit side, and we may have, of course, accounts numbers, as well as the point of the journal being that even transactions is going to have an equal number of debits and credits. Then the general journal here is then what we would then post to the general ledger and use the general ledger to create the trial balance, and then use the trial balance to create the financial statements. So what is this general ledger? General ledger is a grouping of all accounts directly traceable to the chart of accounts. The difference between the general ledger and a general journal is that general ledger contains a summary of every recorded transactions, while general journal contains the original entries for most low-volume transactions. Under the general ledger, we have the subsidiary ledger, which is the group of accounts directly associated from the general ledger. The general ledger and subsidiary or subledger are such accounts that record business transactions. However, while the general ledger is the set of master accounts where transactions are recorded, subledger is an intermediary set of accounts that are linked to the general ledger. We have the format example for the general ledger and subledger in the PPT or in the presentation. And then again, the general ledger is a primary accounting record of a company that uses double entry bookkeeping that is subdivided into two sections, which we have the debit and the credit. To illustrate, we have the general ledger receivable. The illustration shows the beginning balance columns which contains the items. Here in the item column, the posting reference, the debit, and then we also have the credit side, and we have the date and then the item. We also have the account name and the account number, and we can now put the transactions. Again, we need to post these transactions also to corresponding subsidiary ledgers of the account receivable. So the reason for that is for us to identify who are the owners of those accounts, who are the customers who transacted with the company and promised for the payment after we have performed their services. So that is why there is a subsidiary ledger. So it will provide the details of the accounts for the particular customer for the account receivable. We can also prepare subsidiary ledger for the accounts. For example, we have the accounts payable. So the subsidiary ledger will contain specific accounts. You can see the example format for the subsidiary ledger in the presentation. Next is we have the rules of debit and credit. In the process of journalization, the following the rules of debit and credit are essential part to ensure accurate recording and sound decision making. Debit, assets and debit, has the abbreviation DR, which is in Latin root debitum, which means what is due, or we call it value received. When cash or non-cash items are received, the said cash or non-cash items must be recorded in the debit column. This means that the debit balance increased. That is why it is called the volume received. Next is we have the credit. The credit here has abbreviation CR, which in Latin root creditum, meaning something entrusted to another, or the value parted with. When cash or non-cash items are given, the said cash or non-cash items must be recorded in the credit column. This means that the credit balance is increased. That is also why it is called value parted with. For each account title, there are steps that we need to follow. First is to start with add all the debit side to generate total debit. Next is then add all the credit side to generate total credit. Third is to subtract total debit to the total credit. And lastly, determine the balance of each account. Next to rules of debit and credit, we have the trial balance. Trial balance is a list of all ledger accounts with closed or final balances on a certain period or range according to the rules of debit and credit. The trial balance report has two phases. The first phase, which is the unadjusted trial balance, is a report of all balances after the posting of the general ledger accounts. Meanwhile, the second phase is the adjusted trial balance. This phase is a final report of the trial balance after all necessary adjustments in the journal entries are posted in the general ledger. The trial balance looks like this one in the presentation. It have a complete listing of all journal ledger accounts running down to the page with two columns for the debit and credit totals. In the title, we need to mention the period and date since we're looking at a snapshot at a point in time. The account names are grouped by their type. Typically, we start off with assets, liabilities, equity, and dividends, since this is typically out of a balance sheet. Then we have all of the revenue and expense accounts, which make up the income statement or profit and loss. To reduce the size of trial balance, accounts with zero balances are normally left out completely. The columns that the account balances go in usually line up with the normal balances of the account types, which we can remember using the dealer. Dividends, expenses, and assets are normally debit accounts, so these go on the left side. Whereas the liabilities, owners owner's equity, and revenue are normally credits accounts, which go to the right side. The total of the debit and credit columns should always match each other. If they don't, then you'll need to check over your working for errors. We're double entry bookkeeping at all times so that the total debits and credits are always equal. And now we have the adjusting entry. Adjusting entry is the name that is given to the journal entries is posted at the each accounting period in order to bring our books into the alignment with the accurate basis of accounting. Making adjusting entry helps the bookkeeper capture all financial events happened over a period of time within the accounting cycle. Adjusting entries are necessary because the adjusting trial balance may contain up-to-date and complete data. Adjusting entries update assets and liability accounts as well as revenue and expenses accounts. Adjusting entries has 5 basic sources. First is we have the depreciation. Depreciation, this is a method of allocating the cost of an asset to an expense over the accounting periods that make up the asset's useful life. Depreciation can also be referred to as decrease in the usefulness of these types of assets. Example of these assets subject to depreciation are the store, office, building, and transaction equipment. Depreciation usually uses the straight line method, which is the simplest method to compute the amount of this depreciation, which has the formula annual depreciation equals adjusting cost minus the salvage or residual value divided by the useful life, where the acquisition cost is the actual cost of the asset acquired, while the salvage value is the selling price of the asset upon reaching the useful life, and the useful life is the economic or productive life of asset. Here we have an illustrative problem, which is the cost of the equipment is 25,000 pesos. It was estimated to have a useful life of 5 years. It is estimated that after 5 years, the office equipment can be sold at a scrap value of 1,000 pesos. To compute for the monthly depreciation, just divide the annual depreciation by 12. 1 year is composed of 12 months. So in the balance sheet, as of the year or the month, we have, and then we will have the equipment at cost 25,000, which will be deducted by the accumulated depreciation equipment, which will be for the 400 equals the net book value of equipment, which will be the 24,600. So where did this 400 accumulated depreciation for equipment came from? So the accumulated depreciation is an accumulation of all the years depreciation expense, which is this 400 or accumulated depreciation is the contra asset account. This means that it is an asset, but it has a normal credit balance rather than a debit balance like all of our assets accounts. So this accumulated depreciation came from the acquisition cost minus the salvage or residual value divided by the useful life. The useful life. The acquisition value is the 25,000 minus the salvage or residual value, which is the 1,000 divided by the months, which is in 5 years times 12 months. We have 60 months. Divided by that 60 months, we'll have 400 pesos. That is why we put 400 pesos in our journal debit and credit. And the second source of adjusting entries, we have the deferred expenses or prepaid expenses. These are items that have been initially recorded as assets but are expected to become expenses over time or through the operation of the business. In order to recognize the correct amount of expenses, prepayments, shall be amortized weekly, semi-monthly, or monthly, depending on its nature and purpose. The illustrative problem example is it purchased 5,000 pesos worth of office supplies on account. By the end of the month, 2,000 pesos worth of the supplies are still unused. So this is the adjusting entry journal example here in the illustration in the presentation. The supplies expense is an income statement account, while the supplies, which is now credited is an asset account. All assets has a normal debit balance, considering that the supplies in this record is credited. This will be deducted to the supplies account in the balance sheet to generate the remaining balance in the supplies. That is why the only amount here in the debit and credit is only 3,000. Next, the third source of adjusting entries is the deferred income or unearned income. These are items that have been initially recorded as liabilities but are expected to become income over time or through the operation of the business. The illustrative problem, which is on February 15, 2016, Matapang entered into a contract with Makisig to maintain the computers of Makisig for 2 months starting on February 15, 2016 up to April 15, 2016 on the same date. Makisig paid the total contract amount of 40,000 pesos in full. The interest of record and adjust the books are in the February 29, 2016 entry above. As of end of February 2016, Matapang has already earned the service revenue for the first 15 days, thus an adjusting entry is recorded. So the general journal here in the presentation is morning ka nang na kuan sa kaninga problem, which is on the date February 15, they have put the 40,000 amount, and then they adjusted the entry, which is on February 29. They put in the particulars the unearned service revenue, which is the 10,000. The fourth source of adjusting entries, we have the accrued expenses of accrued liabilities. These are items of expenses that have been incurred but have not been recorded and paid. The illustrative problem example is on February 29, 2016, Matapang received the electric bill for the month of February amounting to 3,800 pesos. Matapang will pay this bill on March 2016. The electric bill represents the cost of electricity used or incurred for February. Although the said bill is still unpaid and thus was not recorded, the unmatching principle and accrual basis of accounting dictates that the same should be recorded in February. Otherwise, your expense will be understated and thus the company will be reporting an overstated income or an erroneous income. Needless to say, erroneous information may lead to wrong decisions. The entry to record the accrual of these expenses is here in the presentation. You can see the adjusting entry, which is the general journal. You can see that in the date February 29, in the particulars, they put the account receivables, which is the amount that the company needs to receive from Matapang. Then the service income, which is Matapang's service kanang iyahang murag services, just kaning to record income for the services already rendered during the month of February, which is amounted to 15,000 in the debit, and credit. So the last source of adjusting entries, we have the accrued expenses of accrued liabilities. These are income items that have been earned but have not been recorded and are paid by the customer. In short, these are receivables of the business. Illustrative problem. On February 28, 2016, Matapang repaired the computer of Pedro for 15,000 pesos. Pedro was on an out-of-town trip, so he could not pay Matapang. He told Matapang that he will pay for their services on March 1, 2016. Matapang has already earned the 15,000 pesos but was not paid as of the end of February 2016. Therefore, an income should be properly recognized on February 2016 for this transaction. The entry to record this is, as you can see in the adjusting entry here, the general journal, and the end of February. In the particulars, they put accounts receivable because it is still receivable because Matapang just the kanang nakuha na ni Matapang ang kadtong 15,000 niya katupang March 1. That's why in the general journal we put the accounts receivable because it is still receivable, and that is his debit, which is the 15,000. It is still an asset. That's all of the 5 basic sources of adjusting entries. Again, we have the depreciation, the deferred expenses or prepaid expenses, the deferred income or unearned income, the accrued expenses of accrued liabilities, and lastly, the accrued expenses of accrued liabilities. And that's all for lesson 1. Now we are ready to discuss on lesson 2.
Now we are down to lesson 3, which is to identify where there is a profit or loss for a business. Profitability has always been the overall goal of the business. So, ano ba itong profitability? Profitability is the ability of a business to earn a profit. Ano na naman itong profit? So, profit, in simplest term, is a financial gain. So, sa pagnanegosyo, ang pinakatumong or pinakapangandoy is makaginansya. It's understandable kasi sino namang negosyante ang magtatayo ng negosyo na hindi kumikita, di ba? So, profitability is of great achievement in the successful implementation of strategic, operating, and other plans. So, kapag ang negosyo mo ay kumikita, it means na yung mga strategies, operations, and mga plano mo sa iyong negosyo ay it turns out successful. In identifying the profit or loss of a business, the business will record every detail of all business transactions and translate it into financial report. An income statement is a financial report that reveals the total revenue or income, total expenses incurred during the conduct of the business, and most of all the net profit or net loss as a result of business operations over a specified period of time. Here we have the basic equation of income statement of a service concerned business. So through this equation, we can determine whether the earnings of our business is a net income or a net loss. So when your revenue is higher than your expenses, you make a profit. And when your expenses are higher than your revenue, you'll see a loss. Now let's move on to lesson 4, which is to interpret financial statements, which includes balance sheet, income statement, cash flow projections, and summary of sales and cash receipts. Interpretation of financial statements. So, what is financial statements? As I have mentioned earlier, financial statement is an income statement. So, this will reveal the outcome of the business operations. A financial statement are a set of documents that show your company's or negosyo's financial state at a specific point in time. So this includes key data on what your company owns and owes and how much money it has made and spent. A financial analyst is like a medical doctor who will conduct diagnosis by reading the financial report and render interpretations on it, which will be used as the basis of a sound economic decision making. So, ang trabaho ng financial analyst, they are responsible for financial planning, analysis, and projection for companies and corporations. So, the main role of financial analyst is to pore over data to identify opportunities or evaluate outcomes for business decisions or investment recommendations. Next, we have this financial position. So this refers to the assets of the business which will be financed by the liability and owner's equity. So what is financial position? It is the current balances of the recorded assets, liabilities, and equities of an organization. So this information is recorded in the balance sheet, which is one of the financial statements. On the other hand, financial condition refers to the situation wherein assets, liabilities, and owner's equity are used to maximize income. Also, assets, liability, and owner's equity may encounter growth or decline in value. So there are many available financing tools to be used in analyzing and interpreting financial statements. It depends on the purpose. Most of these tools are able to evaluate and interpret asset growth of the business, profitability, liquidity, and solvency. So in general, it will provide a bird's eye view of the overall health of the business. Now here we have the metrics of financial interpretation with formula. First is profitability ratios. So this measures the ability of the company to generate income from the use of its assets and invested capital as well as control its cost. Next is operating income. This measures the percentage of profit earned from each peso. So we can calculate this by dividing operating income by net sales. And this is expressed as a percentage. Next is return on asset or ROA. So we can calculate this by dividing net income through the average assets. ROA measures the passive value of income generated by employing the company's assets. So this also refers to a financial ratio that indicates how profitable a company is in relation to its total assets. Next is ROE or return on equity. So this measures the return or net income generated by the owner's capital invested in the business. ROE is a measure of financial performance calculated by dividing net income by average equity. ROE is also considered as the return on net assets. Next is the financial health ratios. This refers to the company's capacity to pay their short and long-term obligations as they become due. Next is the debt ratio. So this indicates the percentage of the company's assets that are financed by debt. A high debt to asset ratio implies a high level of debt. So this can be calculated by dividing the total debt by the total assets. So this also measures the amount of leverage used by a company in terms of total debt to total assets. Next is the equity ratio. We can get equity ratio by dividing the total equity by total assets. This indicates the percentage of the company's assets that are financed by capital. So a high equity to asset ratio implies a high level of capital. The equity ratio is a financial metric that measures the amount of leverage used by a company. So it uses investments in assets and the amount of equity to determine how well a company manages its debts and funds its asset requirements. Next is the debt to equity ratio. So we can get this by dividing the total debt to equity, by equity rather. Debt to equity ratio indicates the company's reliance to debt or liability as a source of financing relative to equity. So a high ratio suggests a high level of debt that may result in high interest expense. Debt to equity ratio also compares a company's total liabilities to its shareholder equity and can be used to evaluate how much leverage a company is using. Higher leverage ratios tend to indicate a company or stock with higher risk to shareholders. Liquidity is the measure of the company's ability to pay debts that are coming due. So this refers to the short-term debt. Next is the solvency. So this refers to the company's capacity to pay their long-term liabilities. Next is current ratio. So we can calculate this by dividing current assets by current liabilities. So this seeks to measure whether there are sufficient current assets to pay for current liabilities. Creditors normally prefer a current ratio of 2. Current ratio is a liquidity ratio that measures a company's ability to cover its short-term obligation with its current assets. Next is quick ratio. So we can calculate this by dividing quick assets by current liabilities. So this does not consider all the current assets, only those that are easier to liquidate, such as cash and accounts receivable that are referred to as quick assets. Quick ratio also measures the liquidity of a company by measuring how well its current assets could cover its current liabilities. And that's the metrics of financial interpretation. I guess we are done. Thank you. Thank you so much for listening. I hope that you had learned from the discussion.
So we are now in the lesson 2. Our topic for the lesson 2 is to prepare an income statement and a balance sheet. So before we proceed to the exciting part, to our topic, we must first learn the 5 accounting elements. So the 5 accounting elements consist of assets, liabilities, owner's equities, revenue, and expenses. So assets. Assets is the resources with future benefits that are within the control of the company. This includes cash, accounts receivable, notes receivable, inventory, property, and etc. Next is liabilities. Liabilities are the obligations that the company is required to pay. Accounts under liabilities includes accounts payable, notes payable, loans payable, accrued expenses, unearned income, and long-term liabilities. Or in short, or para masabtan, mo ni sila ang mga utang na kailangang bayaran sa imuhang company. The next is the owner's equity. The owner's equity is the owner's claim in the business. Or there are 2 types of owner's equity. Capital. First is the capital or puhunan. Capital is the value of cash and other assets invested in the company invested in the business by the owner of the business. So next is drawing or withdrawal. Is an account debited for assets withdrawn by the owner for personal use from the business. The next element of accounting is income or revenue. So there are 2 kinds of income or revenue. First is service income. Service income are revenues earned by performing services for a client. For example, laundry services or any kind of business nga naga-offer og services sa ilang client. And next is sales. Sales are revenues earned as a result of sales of merchandise. When we say sales of merchandise, those are tangible goods. For example, materials, clothes, or dry goods. Okay, the next element of accounting is expenses. Expenses is a decrease in economic benefits during accounting period in the form of outflows of assets or incidences of liabilities that results in decrease in equity. Ledger accounts that can be found in the income statement are called temporary accounts of nominal accounts. Examples of temporary accounts include revenues, sales, utilities expense, supplies expense, salaries expense, depreciation expense, interest expense, among others. So the income statement consists of the heading or title of report, name of the company, date or period covered. So the major parts are income or revenues, consist of all income received within the period upon provision of services for service concerned business and sales for merchandising. Okay, so income or revenues, it includes the sales sa imuhang business operations and an increase in economic benefits during the accounting period in form of inflows of cash or other assets or decrease of liabilities that results in increase in equity. So the income includes revenues and gains. So expenses, money spent during the conduct of business operations. So expenses is katong nagasto nimo sa imong business. Example sa expenses is katong nagasto nimo sa materials sa imong business or sa utilities or etc. Basta kay nagasto nimo sa imong business. Okay, so net income or net loss, the outcome of the business operations. Okay, so as what I have said earlier na if the revenue is bigger than the expenses, then you will have the net income or a profit. And if the expenses is bigger than the revenue or your income, your business will have a net loss. Pag dako ang revenue, unya gamay ang expenses, pasabot nakaginansya ka. Pag ang expenses mo mas dako, unya mas gamay ang income nimo, pasabot ato lugi ang imuhang business. So this is now the income statement format. So first, we will have the heading. The heading consists of the name of the company, which is the ABC company. The next is the name of the financial statement, which is the income statement, and the date or period covered. So this is for the period ended June 2018. Okay, next heading is the major parts of the income statement, which consist of income or revenues, expenses, net income or net loss. Okay, so sa service income, mo ni sila ang sales nimo sa imong service company. Then ang expenses, mo ni sila ang nagasto nimo sa imong business operations. So saan man ni sila pagkasunod-sunod. So it could be from highest expense to lowest expense. Then i-add nimo ning mga expenses nimo. Like for example, salaries and wages plus supplies expense plus depreciation expense plus utilities expense equals mo na sila ang total expense nimo pag imo na silang i-add up. And then for you to know if ang imong service income is na net income or net loss. So ang service income nimo less sa expenses or minusan siya expenses. And if positive ang total niya, you will have a net income sa imong business. And if negative naman ang total niya, your business will have a net loss. Okay, balance sheet. Balance sheet is also known as the statement of financial position. This statement summarizes the total balances of assets, liabilities, and owner's equity. Okay, so the balance sheet is the overview of the company's assets and liabilities of a point of time. So usually it is in the end of a quarter or of a year. So the balance sheet is composed of permanent accounts. Contra asset are those asset accounts presented under the asset portion of the balance sheet, such as allowance for bad debts and accumulated depreciation. So the different parts of the balance sheet are the heading or title of report, name of company, date or period covered. Major parts of the balance sheet consist of assets. There are two types of assets: current assets and non-current assets. Current assets, assets that can be realized, collected, sold, used up 1 year after the year-end date. Examples includes cash, accounts receivable, merchandise inventory, prepaid expense, etc. Current assets are arranged based on which asset can be realized first, or in terms of liquidity. Current assets and current liabilities are also called short-term assets and short-term liabilities. So, the current assets, those are the assets of the company that are expected to be conveniently sold, consumed within 1 year. So liabilities, current and non-current liabilities. The current liabilities that fall due, paid, recognized as revenue within 1 year after year-end date. So, the current liabilities are a company's short-term financial obligations that are due within 1 year or within a normal operating cycle. So this includes notes payable, accounts payable, accrued expenses, for example, utilities payable, unearned income, and etc. So non-current liabilities, liabilities that do not fall due, paid, or recognized as revenue within 1 year after year-end date. These are long-term obligations listed on a company's balance sheet. These liabilities have obligations that become due beyond 12 months in the future. This includes loans payable, mortgage payable, and etc. Non-current assets and non-current liabilities are also called long-term assets and long-term liabilities. Next is the owner's equity or capital. Capital is an item of balance sheet wherein the capital or interest of the owner of the business is listed. Initial withdrawal of capital will be recorded in a drawing account of the owner and will be reflected as a deduction to the capital balance. Okay, so the owner's equity is the capital is the value of cash and other assets invested in the business by the owner of the business. Okay, so this is the format of the balance sheet of a service type business. So first, we have the heading. The heading consists of the name of the company, which is the ABC Company, the title of the report, the balance sheet, and the date or period covered. So the date or the period covered is as of June 2018. The major parts of a balance sheet consist of assets, liabilities, and owner's equity. So the purpose of balance sheet is to know the overview of the company's assets and the liabilities of a period of time, usually in the end of a quarter or a year. Always take note that the total assets should be always equal to the total of liabilities plus the owner's equity.